So, the average UK house price fell for the fourth month in a row in December, according to Halifax, with experts expecting a further slowdown during what the Bank of England expect to be a long recession. This isn't just a blip we've seen, that's the biggest drop in house prices since 3 months to February 2009, just before the Great Financial Crisis. So perhaps you're concerned about what this means for you and your money. You know, whether you're holding back on a big decision, maybe moving house or remortgaging, or perhaps just getting onto the property ladder for the first time. I mean, if an Englishman's home is his castle, then surely his house price is. Anyway, in this video, I'm going to be telling you the very latest in the data that could have a big impact on you in the next few years for the property market. I'm going to also be telling you what the last 2 crashes in the UK housing market can teach us today, and why this time could be different for the UK property market. So that relentless juggernaut, which has been the UK housing market for the last 30 years, could be about to go. Before I go into the future, I need to provide a bit of quick context about where we came from, because it sort of frames everything that's going on. The UK house prices have been high for a very long time, and coming into this, the house price to earnings ratio were near 9 times. That's how much the average house costs compared to average earnings. Roll on the pandemic and everyone was locked indoors with very little to do, and we collectively decided, I need more space. And that makes sense in many ways. But what we also did is we dropped interest rates next to zero. The combination of the lower financing costs and the fact that also a stamp duty holiday was put in place was meaning that we all focused on our surroundings, and it was this combination of lower finance costs, stamp duty holiday, the fact that we were more interested in our surroundings, and it led to what was called the race for space. Anyway, according to the Bank of England blog, analysis of housing transactions during the pandemic found that just under a half of recent increases in house prices can be attributed to the race for space. So there was a 13% increase on average from June 20 to June 2021, and the Bank of England blog states that almost half of that was specifically due to pandemic-related reasons. So is there a perfect storm brewing here, where things bounce back, where we have an era of free money ending, meets a market which was at its peak and already gone a bit crazy?
Doing is we're raising rates expeditiously
as we adjust, as we must do, and as markets are doing, from the experiences we've had in the last month or so.
Or is this just another minor blip, and like many before who have bet against the UK housing market, we'll just get proven that actually in the UK things really are as safe as houses? Okay, so how to watch out for a crash? So let's go back to those basic principles. Generally, house prices are typically affected by 4 factors: real incomes, interest rates, the availability of mortgage finance, and supply. So let's look at each of them and see which one we can tick off as an issue right now. So real incomes first. That just means whether income is rising or falling when adjusted for inflation. And we know that's a huge problem right now, frankly. Because of the cost of living crisis, wages just aren't keeping up with inflation. This affects people's ability to afford a new home, so it's a big tick on that one. That's a problem that could affect house prices. In fact, it's one of the worst times for real incomes in decades. All right, second is interest rates. This hugely affects how much it costs to borrow money for a mortgage. In 2020, they were near zero. Now anyway, current expectation is that the base rate will peak about 4.5%. And that's because it's been rising because Bank of England have been trying to manage inflation. That's also a big problem because it's basically dead money. You know, if you have a 300 grand mortgage, and let's just say it's interest only to make it easier, and your interest rate goes from 1% to 4%, your interest payments go from £250 a month to £1,000 per month. I know your house doesn't get any better because of that. You're just paying more in financing costs. That means that many can't afford the borrowing, and they can't buy, demand collapses, and prices follow suit. So big tick there. All right, 3 is the availability of mortgage finance. And mortgage finance enables people to borrow money for a new home, and it's driven by banks and their appetite and balance sheets. And the truth is, this is actually decent at the moment. It does typically change in a recession because tightening of lending tends to happen then. But it's a bit meh right now, so not sure, certainly not a tick, but watch out. And finally, supply. And you could argue that maybe that's the saving grace in this picture. Whatever anyone says about affordability, we still have a supply issue in this country. Compared to historic levels, we're not building as many homes as we used to. So the long-term trend is people in the UK are short on housing. Big regional differences, of course, but in general, that's true. But there is a potential area of the market which could have a lot of forced sellers that maybe hasn't come forward yet. I'm about to tell you that in a second. So let's have a look back on history. The phrase goes, history doesn't repeat, but it does rhyme. So what can we observe from history and consider about now if we're thinking about a potential house price crash? Can we learn from what's happened before, perhaps? Okay, so let's have a look. Well, the UK housing market downturn that started in around 1988 saw prices fall in absolute terms, and this continued all the way till 1994, with a drop of around 20%. But it wasn't actually until 1997 that house prices began to rise again by more than 5% per annum. And then, of course, there was the big bull run in house prices. Annual house price inflation then persisted, and it was above this level for the next 10 years until it peaked in the final part of 2007. Now, the next drop in UK house prices was obviously the Great Financial Crisis. House prices fell consistently across pretty much all regions until the spring of 2009. The average national drop was 21% at this time. Though these are two house price crashes, it's really important to understand that the anatomy of these drops were very different, and there's something we can take from this. Although both were, of course, falls in prices linked to recessions, in the 1990s, the downturn was really driven by forced property sales due to extreme interest rates and high unemployment. Households were in negative equity and unable to make their mortgage payments. Now, in contrast, the one that surrounded the Great Financial Crisis saw high unemployment but low interest rates. And it was more the widespread withdrawal of mortgage finance after the banking crisis that caused the issue. Banks were forced to shore up their balance sheets rather than lending. It's also important to bear in mind that a lot of mortgages taken out prior to the Great Financial Crisis didn't have the best evidence of affordability. So while they were both quite different crises, where are we going forward? Well, if history does repeat, and that's a huge if, unlike 2009 right now, bank balance sheets are in a decent position. Interest rates have risen and they're generally more profitable banks. So while they might be more selective on lending going forward, this time around there isn't the hesitation or the risk management, which means they'll probably continue to lend to people who can afford it. Okay, the next point is that we are under interest rate pressure here. We're not expecting anything like the general numbers of around 10% like we had in the 90s. But the key thing to factor in here is when you adjust the impact of interest rates on affordability. And what this means is the fact that house prices are much more expensive compared to income than they were back then. A 6% mortgage rate is today equivalent to 13% back in the 1990s, according to this research. And the reason why is that's basically because you have much more debt compared to your income level. So actually on the interest rate issue, this is broadly equivalent to the issues that we had in the 90s. So I'm just about to tell you where I think forced sellers in the market are going to potentially come from. But if you are enjoying this content, please do consider subscribing. I do a ton of videos on personal finance and making better decisions, and it'd be great to have you on this journey. Okay, so where are the forced sellers? At the end of the day, prices, when it comes down to it, purely are a function of supply and demand. So on the supply side, the forced sellers are the ones who may decide to sell and sell fast. And landlords with outstanding mortgages on their properties, I think, are a real target for this for a few reasons. Most will start to come off their fixed rate if they haven't already in the next few years. And as typically, you pay a premium for finance costs as a landlord. That might make many buy-to-let projects unaffordable. And that's one of the reasons why we've seen such a crazy rental market recently, in anticipation of that, I believe. But the big trend that this is following is the government has made it continually less attractive for people to be private landlords. So it's what's called Section 24, which means unlike previous years where you could deduct your full mortgage finance costs, you can now only receive a basic rate deduction. And that's without also going into things like the capital gains tax exemption is going to be cut in the next couple of years from $12,300 now to $6,000 next year and then $3,000 the following year, which is going to hit landlords hard if they have to sell and could incentivize them to want to sell early. There's also lots of proposed changes in relation to minimum energy efficiency standards for landlords, and all rental properties will need to be an EPC rating C or above by 2025 for new tenancies and 2028 for every existing tenancy is my understanding. So some properties could generally cost tens of thousands to get up to that rating if they're not well insulated. And that's before also talking about the renter reform bill, which means that tenants are generally going to have a lot more rights going forward, which isn't necessarily a bad thing, but it is a consideration for landlords. And if we take data from Hamptons, we can see already the share of sales to investors is declining. And personally, I'd expect that only to increase going forward. So here's how I think this might all play out. So kind of borrowing from Savills projections here, as it seems well reasoned, what is likely is, look, people who have already got a mortgage with a few years left on their mortgage are unlikely to sell. meaning less transactions. Those who don't have a mortgage clearly won't be as affected by mortgage interest costs. But in the wider market, look, they're still going to be impacted by the wider trends. It's not just the amount of people who have a mortgage, it's the impact of the whole market and the transactions. So prospective buyers, whether that's first-time buyers, just potentially can't even afford the cost of mortgages anymore. But they'll have less money already because of the cost of living crisis, and this will reduce transactions. This is big, and with the data from Halifax showing that in the black line here, that a significant amount of transactions from home purchase loans were driven previously from first-time buyers. And then adding on top of that, we also might have quite a few landlords that consider exiting the market altogether because it's no longer profitable for them. So right, what's my prediction? And I think in the last couple of years of this channel, I've been sat on the fence perhaps a little bit too much, but I'll put my prediction on the table, and remember, it's just a guess and it's by no means going to be right. So my views, look, I think people were already stretched as far as affordability for mortgage payments, and that's even before rate rises and the cost of living crisis. What I do think these negative projections will be missing is the wider context where we've been coming from. Look, we've been coming from a really long, sustained bull market and then a pandemic where there was a real uneven spread of outcomes financially. I don't think it's going to be a sharp crash, but a correction of 8 to 10%, which in many ways is probably just going to retrace the gains or some of the gains made during the pandemic. But where I think the pain will really be felt will be more stagnant growth going forward in house prices. So actually growth coming out of this probably will be slow or non-existent for quite a few years going forward, which means that once you adjust the growth for inflation, you could potentially see 20% plus house price falls because it's the inflation outpacing the growth. Again, just a guess, just my opinion. So what can you do? Now, what's the point of knowing all this all? And look, I know it sounds a little bit gloomy, but just remember, a house is a home in my view first and not an investment. So whether you're buying already or you've got a mortgage, it comes down to, can you afford the repayments if your fixed rate is going to end, managing your personal finance position and doing the figures yourself. But maybe thinking, well, I'm glad that I chose my property over my pension. Well, if that's the case, it might be worth giving this video a watch.